So the Roth DCP is finally launched in October, and it is an amazing tax planning opportunity that everybody should be considering. Now, this strategy alone over the long run can easily save you 5 to 6 figures in taxes alone. So today I'm going to explain to you how the Roth DCP conversion works and how can it benefit you tax-wise over the long run. All right, so when it comes to the tax piece, remember that with DCP, we have never been taxed on this money yet. This is what's known as a tax deferred account. Same thing with 403Bs, Plan 3, 401Ks, anything you haven't paid taxes on this money yet falls into this bucket here. And then we have something called tax-free accounts. You want to think of this as anything to do with the word Roth. And now that we have Roth DCP, it falls in this bucket over here. So tax-free accounts, you pay the taxes initially, then it's going to grow for you from that point forward, completely tax-free. So when we do a Roth conversion, what we're doing is taking money from our current DCP account and putting it into the new Roth DCP account. So money's moving from one pot to the other. Now, when we do this, we have to pay the taxes on the money that comes out. And the taxes due is depending on what tax bracket you fall into. So it may or may not make sense to do it this year, depending on what your future tax situation might look like. So before you will pull a trigger on this, you want to have somebody do an analysis to see what future retirement income you're looking at when they add up things like your pension, your Social Security, any kind of rental income. They want to add it all up to see where you're at in the future and if you are going to change brackets, and if so, how much. So that's the first equation that needs to be done. Now, when we do this, for example, let's say we're going to move something like $10,000 over here. So what's happening is $10,000 is coming out of this DCP account, and it's going over into this Roth. So when it's all said and done, you're going to have $10,000 in this Roth DCP account. Now, taxes. Let's say you're paying 20% taxes on this. So on this would generate a $2,000 tax bill. Now, the taxes in this conversion have to come from your bank account. You can't have it withheld. You can't say, hey, convert 10,000, hold 2 and just put 8 in the Roth DCP. No. The whole 10,000 is going to move over. You're responsible for putting the $2,000 in, giving it to the IRS through an estimated tax payment. Now, it's best to go ahead and make the estimated payment before the Q4 deadline, which I believe is January 14th. If you don't do it before then, you could be looking at an underpayment penalty because government doesn't like to wait till April to get the taxes from you. All right, so that's essentially what's happening with the conversion, moving money from one pot to the other and paying taxes on it. Now, why in the world would they want to do this, and how is this going to save you taxes in the long run? Well, if we didn't do this and we said, hey, I'm just going to let it sit there so it can continue to grow, I don't want to pay taxes right now. Anyways, taxes are high. Well, if we were to wait, let's say 15 years, and your $10,000 then becomes $30,000, you still have to pay taxes on all that money. If taxes are the same, you're paying the same 20% of that number. Now your tax bill is looking like $6,000. So congratulations, we waited, we tripled our money, we also tripled our tax bill. So that's what happens when you put off doing kind of conversions for the Roth account. Now, if you did the Roth, same situation, right? Same investment, same time period, it's still going to grow the same. You're going to have $30,000 here. But because we paid our $2,000 tax initially, this $30,000 is yours 100% tax-free because you already bit the bullet on it. So while some people might look at this and say, hey, 30,000 and 30,000, that's the same, this 30,000 already has taxes taken out of it. This one still hasn't. So if you were to take off $6,000, you really only have $24,000 in this account. And that was assuming taxes stay the same. What happens if taxes go up? You're obviously going to be left with a lot more money. So this is just an example of how the Roth conversions work and how it can save you taxes. Now, this was just showing a small amount, obviously, right, of $30,000. So in this case, you saved about $4,000 in taxes by doing this conversion. Now, if this was $300,000, you'd be saving close to $40,000. And then again, the longer you wait, the bigger this bill get. For most people, this can be well over $100,000, right? But what happens if taxes go down, or I'm going to make less money down the road, so my taxes are going to be lower, so I'll just wait to do it then? Well, let's take a look and see how that actually works for people. So let's assume that we have $400,000 sitting in our pre-tax accounts. Could be DCP, could be 403Bs, Plan 3, whatever it is. It's some account that we haven't paid taxes on this money yet. Now, let's assume, to make math easy, that your tax bill is 25% of this money. So you already don't have 400,000, you still owe a quarter of it to the IRS, which means your tax bill on this is $100,000. Now, if we wait to do any kind of Roth conversion or think we're going to pay less taxes in the future by making less money, remember that tax can only do one of three things. They're either going to go up, they're going to go down, or they're going to stay the same. Now, when we wait, our money obviously grows, or at least that's what we like it to do. Now, if you use the rule of 72, if you earn 7.2% interest, your money is doubling every 10 years. So 10 years from now, this person would expect to have something like $800,000 in here. And if they wait another 10 years past that, earn the same 7.2%, they're going to look at about $1.6 million in this account. Now, let's do some math here. If taxes stay the same, and we have 25% tax here, but our account is twice as high, that means the tax bill is now twice as high. So the tax bill here is $200,000. Now, let's just say what happens if taxes go down, right? Let's say you drop to 15% taxes. Well, 15% taxes of 800,000, you're now looking at $120,000. So just because we drop tax brackets doesn't mean we owe less taxes, because our account's now higher. So you can see this is now $20,000 more than it was 10 years earlier. Now, if taxes go up, let's say to 30%, obviously that means more taxes. In this case, it's going to equal $240,000. So you really have the choice of, we can start converting now and pay $100,000 in taxes. We could wait, taxes are the same, we could pay double, we'll pay $200,000. We can see if we go down and pay $20,000 more, or if taxes go up, we'll pay $240,000 more. So it's your choice on, if you want to put it off down the road or start taking action now. And if you really put it off and went to this 1.6 million, all see these numbers are just going to double. So now you're looking at 480,000 here, 240, and 400,000. So I said at the beginning of the video that retirement taxes are a huge bill and can easily be in the six figures. This is what I'm talking about here. You can see that you could potentially owe the size of a mortgage to the IRS just by simply doing nothing and waiting down the road. So it's why it's important to take action in terms of your tax planning and start looking at things like this new Roth DCP conversion to actively see, is now a good time to do it? If so, how much? Because chances are down the road, your account's going to grow, your tax environment's going to change, and you could be left paying more taxes than you realize. And this is our goal, is to help you guys minimize your lifetime tax bill. So you're doing a Roth conversion today, 100%. You're going to be paying a lot more taxes today than you would have if you didn't. But if we extend the time horizon and look down the road 10, 20 years, you're going to be saving upwards of six figures in taxes alone. And this is just off of a $400,000 account. If you guys have more than that, you can bet your bill's going to be bigger than this. So I hope that helped you guys understand the purpose of the Roth conversion and why it's important to start taking action now. If this is something you guys need help with, figuring out if it's a good idea, should I do this? How much should I do? How do I fill out the form? How do I make sure it actually gets reported correctly to the IRS? Because remember, this is the first time DRS is doing this. There could be some hiccups when it comes to tax filing season and how they adjust their forms. I've seen it before. So if you need that kind of help, that's what we do here at Scenic, is we just help people, Washington State employees, with their retirement planning. Tax planning is a huge part of it. So any of our financial planning clients, this is something that we do every single October like clockwork, is going through this exact calculation to see, should we do the conversion? And if so, how much? We run it by the CPAs to get their stamp of approval, and then we're on our way. So if you need this kind of help, the link is in the description to get on our calendar, and I hope to speak to you guys soon, and I'll catch you guys next week. And remember that your future depends on what you do today.